We've already taken a look at a small country export tax where we identified the goals of reducing the domestic price and the potential interest of government in earning revenue, and noted the downsides of hurting domestic producers who could otherwise export profitably to the international market. But there are other motivations for a large country which are quite distinct from the effects of the small country case. Most importantly, a large country can restrict the amount of exports that go into the international market, forcing the international price up. So there's a possibility that an export tax could actually be beneficial to a domestic economy, mainly because of taking advantage of its market power in global markets. This is very similar in general effects, but the big difference is that you have a difference of effect on the world price. So we're going to imagine exactly the same policy as for the small country. Again, for concreteness, let's say the world price is 100. We put a tax on of $10. So initially, the domestic price and the amount that domestic producers get from selling abroad falls by $10. That is the export tax. But as a large country, this has an impact on the international market. The reduction in the exports of this product will result in a significant fall in the supply of this product on international markets. That's going to affect the international markets. That's going to raise the price in the world economy. And that we're going to depict by P1. Now, how much P1 increases depends. Depends on the supply and demand elasticities of this product in the international market. All I know is that the world price will rise. Now, what is the price that domestic consumers and producers finally receive? Whatever the world price is, you're going to reduce what domestic firms receive by that same tax rate. So we now have the new domestic price equal to P1 minus T. So you'll notice that the domestic price doesn't rise quite as much as in the small country case. Now the effects on consumer and producer surplus are going to depend on or how we're going to compare it is between the prices in the original situation before the tax and the domestic price after the tax has been imposed and all of the international consequences have settled out. So we're going to be looking at the difference for consumers. Oh, I should say first that we have a different level of consumption and a different level of production associated with this final price. Domestic consumption rises to Q3, domestic production falls to Q4. So we're going to take a look at the consumer and producer surplus. Well, this is quite similar to what we've done before. Consumers gain. They gain the area defined by the difference in the price over to the demand curve. It's going to be area E. That's that whole trapezoid. Domestic producers are going to lose E, F, G, H. That's a difference in the price over the supply curve. So we have consumer gain, producer loss. Now there's a little bit of more complicated story about the tax revenue. The government is going to gain area G. It's the area in the middle. Students often want to say, well, that's the effect of on the government revenue because it tends to be the thing in the middle. But there's a further impact. We have an area I. Now, what is that? If you take a look on the graph, the world price rises to P1. The domestic price is P1 minus T. The difference between those is the export tax rate. So the total government revenue is the difference, the tax rate multiplied times the exports, and that's going to be area G plus I. Now, I has a very important interpretation. I is that part of the export tax which is paid for by foreigners who have to face a higher price because of the reduction in exports of this large country. So some of the export tax is foisted off, is passed on to international consumers of this product. So that some of the export tax is borne by foreigners, not just the domestic producers. So that changes the welfare calculus a bit. Take a look at the net effect. So we've got gains of E, G, and I. That's the effects, the benefits to consumers and also to the government. And we have losses of E, F, G, H to domestic producers. We're going to consider transfers having no effect, so the E's cancel, the G's cancel. Now we have a slightly different circumstance. We have a ambiguous net effect on the domestic exporters, or I'm sorry, the domestic economy. I is that part of the export tax revenue paid for by foreign producers, foreign consumers, foreigners, and F and H are the same deadweight losses that we had talked about in the small country case. Could this tax then actually result in higher welfare for the domestic economy? It absolutely could. If area I, that is that part of paid for by foreigners, exceeds the inefficiencies into the domestic market, this is actually a good policy from a welfare standpoint. In fact, if you select a policy very carefully so that you maximize the difference between the revenue gained from foreigners and the domestic inefficiency, then you can have what is called an optimal export tax. That is to say, a tax rate that maximizes the benefits and minimizes the costs. Now, not surprisingly, this optimal tax rate depends on a lot of different things. Most importantly, it depends on the import elasticities, the export elasticities, basically the international market conditions. And those are not known with certainty by government. You could have you're basically trying to estimate the impact of this policy on the world market. Well, you could get it wrong. You could have a smaller I than you had planned because you didn't get the price response estimated correctly. You also have the clear downside that the benefits to the export tax come about because the domestic government has essentially taken money out of the pocket of foreigners, and they could retaliate. So the ultimate effects of this policy of trying to pursue an optimal export tax depend upon information needs about market conditions and the responses of foreigners. So it's potential to have an optimal export tax, but it's sometimes difficult to impose. Having said this, there are a number of countries that will try to use export taxes as a way to gain advantage in international markets. Ultimately, this is a kind of monopoly power. You are restricting the amount that you sell internationally to your advantage. It's very much like what you would have with a domestic monopoly who's restricting output to get the prices up and with possible profitability.